Okay, let's get started. Welcome to our presentation, How to Invest in a Fear-Driven Coronavirus Market and When to Act. In this presentation, I will be allowing you to ask questions, and you can also make comments. And if you put a comment in, I may read that comment out to the group. Normally I don't take questions because it destroys the flow, but there's so much information out there, and some of the people in the room are highly experienced and may have something to contribute. So I'm very happy to repeat comments if they're good. If you're going to ask a question, ask a proper question. Don't just ask a very vague question. It's really hard in real time to answer things which are vague. So let's get started right now. So let's start with, who is this presentation for? This presentation is for investors who want to think in a logical and objective way, make clear decisions and not be driven by fear. I have done this presentation now 3 or 4 times, and largely it is a repeat of what I've already done, but I'm increasing particular topics and also obviously adjusting my analysis in real time as the market unfolds. Who am I? My name is Paul Wise. I'm the founder of Momentum Investing, and another company I use is Options 21, providing educational and advisory to high net worth individuals, both retail and institutional. I started my career as a registered representative of the Sydney Futures Exchange, and I am the responsible manager for an Australian financial services licence. The number's on screen. I believe it's important to stamp my authority on what I'm saying today, because I'm not just an average guy out there which is making commentary. Apart from the decades experience I do possess, I've recently passed all my professional examinations to be accredited with professional status as a certified market technician by the Market Technicians Association based in New York. That's a 3-year process of certification, and I still have to write some reports for fund managers to get finally signed off, but all the examinations are out of the way. This is my area. I'm very familiar with what I'm about to say, and have practiced what I'm saying for quite a while. Just that's not true as of yesterday. As of last week, when I took this screenshot, people are asking me how am I going in my personal investment, and I'm at this point for the calendar year going backward from March 19th, I'm ahead 15%. How can I be ahead 15% in a market which is falling 30%? I'm about to give you my personal answer for what I did, which may be your answer as well in the months ahead. This is what I did. As the market topped out recently, I think it started from the 21st of last month, and it had that first gap, my stops went off and I'm out. But I am old enough, I'm in my 50s, I've lived these cycles before. I've lived, the GFC. What I observed in the GFC is something that's happening at this point in time, which is a little bit off topic, but that is a correlation of asset classes, which gives you nowhere to hide if you're looking at diversification of a portfolio. That said, what I did observe was the flight to safety within currencies. I am standing in Australia, on the west coast of Australia. So this answer will not be your answer if you're in the United States or New Zealand maybe, or maybe it is New Zealand or Europe. But I shifted all my funds from Australian dollars into the US dollars. And as the Australian dollar has tanked in the past few weeks, that's why my account's positive. So it's not magical. But what it means for me personally is that I have zero anxiety. I have no emotional or cognitive biases affecting my decision making, and I'm able to sit here and wait for specific opportunities, which I'm going to give you today, that you could take advantage of, which there are 2 major ones I believe are there. But that was my number 1 opportunity, was to do something and use, I suppose you'd call it a currency hedge if you like. So I would not going to do a complete analysis on the Australian dollar, but we are getting hit from all sides, primarily demand out of China, and also lowering of interest rates are affecting our currency. It's a many-faceted event, but there'll probably most likely be a ongoing downward pressure on the Australian dollar. If you did a correlation analysis of the Australian dollar and the equities market, the Australian equities market, you'll find there's a good correlation in these times of panic. And I could say a lot more on this topic, but that's not what I'm about today. So I just want to make a comment of how we assess uncertainty. I've just got someone typing in that they have no sound. I'm sure everyone's got sound, and that's probably a technical issue for that one person, so I'm not going to stop. How do we assess uncertainty? The only way you can assess uncertainty is to use logic and objective assessment and not be anxious. If you're anxious, it's usually a function of where you are with your current account, and also you're watching too much of the news. Watching the news is not going to change anything, so I've always recommended people to stop looking at news constantly, because it's just going to get on top of you, and relax and switch off, because especially in finance, the higher the stress level, the higher is the degradation of your decision making, and that is not good in this environment. So just a small tip. I also would recommend, if you're listening to pandemic news and you want specific news, you must go to experienced medical professionals. They're the only person we've got to be listening to. Don't go on the internet. I've seen some ridiculous nonsense, and the reason being is they're professionals. Where they're professionals in the context of something that has been happening, and that is a pandemic that's driving what is a fear-driven correction. But I would like to point out that this correction has a starting point. We know when the starting point was. It was back last December. It has a midpoint, which will be, for me, in the terms of a financial cycle, the bottom of the correction, and then it has an end point. But I'd like to point out there's two cycles, and I want to talk about that today. There are two cycles within the market. One's a financial, one's an economic. I'll demonstrate in a moment. It's very important to be able to strategize and understand this, so you're not getting sucked into just negative news. I also want to point out, just as medical professionals, and I've got some in the room right now, have spent decades with their education, experience of doing some amazing work out there. There's some really good financial professionals. You need to be listening to well-qualified financial professionals, not on the internet. I just know there's some people just thinking this is a game and thinking they can do stuff. They're going to go bankrupt. This is a very tricky market. I'll use the word fast market. I haven't got time to explain. But if you're observing a market that starts jumping around irrationally, it's a liquidity issue. And I know it's there because I know the people who are, involved in big trade, and they can't place a trade. It's actually evolving into a very tricky market, and just a word of warning. I'm sorry I haven't got time to explain that in full. On a positive note, I do have friends in Wuhan province. I spoke to, or my friends in Melbourne that actually have got their friends in Wuhan province, and she was extremely positive when I was talking to her this morning. Jin, she said all her friends are really happy. They're all back. They're walking the streets. They're all at restaurants. So it's kind of positive, but we don't know actually if the Chinese have moved too early. But if they have reached a point where they are able to get back to work, and they can at the same time keep their reinfection rate low, that starts to give us some concept of the okay, I've just got to stop here. I've just got two people who have said they haven't got sound. Can I just get some feedback on sound? I'm going to continue, but there can be localized issues because I know there's a degradation of the internet across the world at the moment. So if everyone could just type in, we're good. I'm just going to continue for the moment unless I've got a group of people telling me they've got no sound. So there's some positive signs in China. So the duration of the Chinese experience will dictate the duration of this crisis. And if this crisis morphs from a medical crisis into a financial crisis. Thanks for everyone saying they're good sound. So I'm just making a point. There are localized issues around the world at the moment, and so I'm not going to stop. There's just two people, one in Adelaide, one in I don't know where. I'm just going to continue. The duration will dictate if this crisis morphs into a financial crisis. I want to make a point. This is not a financial crisis yet. The reason people are perceiving it as a financial crisis is because of the news, and they're talking about recession. You've got to make a distinction between what is an economic cycle to a financial cycle. When I hear people talking about, this is the silly stuff I hear about, it's a 1929 crash. That's not true. The banks are actually really solid. The banks, I'm talking the Australian experience. I'm not exactly sure what's happening in the US. The banks have gone through stress testing just recently in the GFC, and they've had to repeat that just 3 years ago. The banks are liquid, absolutely liquid. That's what quantitative easing is. As you should be now aware, that's the Reserve Bank buying government bonds. The government is therefore liquid with cash, then they on-lend it to the banks. That's why the banks in Australia are making all these good deals at the moment and giving you holidays. So there is not a financial crisis in the context of 2009. And I'd like to point out the financial economic theory that was used back then, now just did not exist back then. This is a much more sophisticated world, and the response that I'm seeing is one which is coordinated across the globe from governmental, fiscal and monetary policies. So I strongly recommend you stop focusing on the negatives and start focusing on the positives and start strategizing, understanding that there are two cycles. Because if you don't start to calm down and strategize on the positives, you're going to end up like this chap at the end of the process, when I know 100% I'm going to end up like this guy when he pops up on screen, happy. I'm going to be undamaged in any way as long as I stay away and stay in my office, and I'll be financially okay, and that's my objective. So in this presentation, there are quite a few points I would like to cover. I want to make sure you understand there are two cycles within the market, a business and a financial market cycle. I want to describe to you the context of a correction. Now, this is something that's happening in real time. So if you're hearing it in, if you've heard it before, well, we've gone down another week and something else has happened and I can add commentary. I want to talk to you about the time taken for a correction to unfold. I want to talk about a three-way structure. Crudely, I call it the dog leg. I want to talk about technical price structures, a technical price structure of a correction. I want you to understand the VIX and how it impacts on the corrective phase and how it lets us get a sense of the depth or the width of this corrective phase. Someone was saying 2 weeks ago, oh, Paul, the volatility's left the market and it's going to go up. I said, there's not a chance of that occurring anytime soon. I want to talk about technical price patterns that may trip you up. I want to give you a definition of a meaningful support line. Patterns on screen at the moment and lines on a screen are not meaningful without other information. They're just lines on a screen. I'm going to do some Fibonacci projections using tools that I found historically are very useful in picking up the emotional lines where people react to the market, even if it's just like people like myself managing large trading groups in offices around the world, which are probably not occurring. That's why we've got a liquidity crisis happening. People are reacting at particular levels. These levels are dictated by Fibonacci projections, and I'll show you in a moment. I'll quickly mention volume behavior and just make a point that this is only 50% of our hedging and market correction model, and everything beyond this presentation is custom. It's what I give to my private clients. So I'm just pointing out this topic is huge, but I'm going to give you some really good stuff that you can walk away with. My first point is talking towards cycles. This is an important thing. I need you to distinguish between the financial and the business cycle. I'm not going to give you a lecture on this traditionally because I just want to make a point. The financial cycle is the stock market. The business cycle is the economy. When they talk about, in the media, recessions and even depressions, we're talking about the business cycle. We're talking about the ebb and flow of GDP, which dictates the strength of an economic contraction and expansion from full expansion to full recession. When we're talking about the financial cycle, we're talking about bull and bear markets. They are two very different things, and they do not operate in lockstep. In the concept of a unique event, a fear-driven event, which has no basis in geopolitical or economic origins, you really want to distinguish between the two, because we could have a business cycle which does go into a small recession or a recession, which may or may not be extended. It's too early to tell because we're just starting. But the financial cycle could be totally different. And people will focus, as they do, on the negative, the business cycle, and miss out on the financial cycle, which is where the opportunity is, which is one of the opportunities I would like you to be aware of today. So very quickly, just making sure, business cycle, it's known as the economic or trade cycle, downward and upward movements of gross domestic product around its long-term trend. So that's where you go from boom, recession, slump, recovery, boom, recession, that GDP growth, up and down, back and forth around its average. As against the financial market cycle, the stock market, where some securities or asset classes perform, others don't perform. Some perform because their business models are aligned with conditions for growth. You tell me, is Wesfarmers or businesses like Woolworths, Coles, where was I today? Bunnings. I was down at Bunnings on Sunday. It was like Christmas shopping. Doctors' surgeries, chemists. There are segments of our economy which are totally out of step with the rest of the economy. They're going to do really well. So this is about optimism, enthusiasm, exhilaration. So where are we at the moment? We're in we've gone from unease, and I think a lot of people are still in denial. The reason they're in denial is because this is all unfolded so rapidly, and it's very difficult to get your brain around how fast this is happening. And we're about to head into, I believe, from a psychological perspective, the pessimism, and we are definitely not in the panic stage. We're in the panic stage when things look horrible on the news. Well, not that they're not horrible, but there's more to come. This pandemic, and again, I'm not making a medical forecast here, is 6 minimum, more 12 months, unless something happens. So that's going to go on for a long time. That's what's driving, the business cycle. But the financial cycle has got different drivers. This could be, we could go into a supposed bear market corrective phase, but we could punch straight out of it. And we could punch straight out of it due to the liquidity sloshing around in the system, which needs a home. Some people have told me, oh, that home's going to be real estate. I don't think so. And well, again, I've got to qualify my comments. I'm not a real estate advisor, but I am a person that has lived recessions. And I know, because I sold real estate in the last recession, was back in the 80s, that if we go into a business cycle which has a small recession, people lose their jobs, people can't finance loans, and therefore default rates on real estate go through the roof, and therefore real estate backs off. Think of the experience in 2009 in the United States. So I don't think money's going to flow from the stock market into real estate. I don't, and that's just a comment from experience. What I do think is that on the first sign of hope, we'll see a stampede back into equity markets, and or if we don't, it'll be a stampede into something else. It will be a stampede into gold. I can't tell because that's a future event that has not occurred, but I'm just giving you all the alternatives so you're starting to strategize with a positive frame in your head rather than focusing on all the negatives that you're hearing on a daily basis. And I want you not to end up like this guy. Okay, I need to switch now from a PowerPoint presentation to a price chart, and it's a little bit clumsy. Just give me one moment. I've got multiple screens around me, and I'm dragging screens and pictures which will be embedded on your side very shortly. Just give me one moment. I still have to extend my screen out. I'm trying to get as much information on my screen as possible, and I believe I'm almost there. Okay, I'm there. Okay, I've just got a comment from Max now. Max, I'm just going to make a comment without telling you who Max is. He's a very experienced global financial professional. And Max says, yes, agreed, Paul, QE, quantitative easing money, will firstly flow into the most liquid asset equities. So this is how financial professionals are thinking. This is how I'm thinking. And then you get the retail level that are saying something completely different, where, you know, which is because they're hooked into the economic cycle, the fear cycle, that cycle. Okay, this is a repetition. I've done this 2 or 3 times before. This is a technical interpretation of what may happen. The technical interpretation and its speed of how it unfolds is dictated by the speed of the information flow, and it's very negative and will be increasingly negative. That said, during an unfolding crisis, it's not all negative. We get little bits of positive news, which I'll talk about in a moment, and that causes certain things to occur. So there are 2 things that are going to happen, or are happening right as we speak. One is a straight capitulation style correction, such as we saw in 87. Go and have a look at the chart. Market just went straight down with a little bit of a rally preceding the drop. The second way this market can unfold, which is my preferred or on my wish list, is a controlled corrective phase in the form of an inverted head and shoulders pattern. Now, the reason I've got so much information on screen is that I lived this just last year with a 20% correction. I would like you to point out, I'd like to just point out before I start talking about it, is that each of these corrective phases are driven by something different. And what's really interesting about this one, just going back to the first one back in October, November, December in 18 into 19, that was US Federal Reserve, if I've got my memory brain correctly structured, talking about increasing interest rates. The market didn't like it, so they had a 19% correction. The second one on screen, which was May, which was, that was Trump and China squabbling over tariffs. August, Trump and China squabbling over tariffs. October, impeachment discussion, and then we've got today. What's unique about today, this corrective phase, and all the other 3 that I just described, is the first 4 on screen. Someone could stand up somewhere on the planet, a president or a reserve bank, use soothing words or change policy to change what was occurring and change the trajectory of the market. This is a unique situation that there is no one on this planet that I know of that's going to change the trajectory of what's happening in front of us. That said, it is driven by a constant that I'm very familiar with, and it's called human life forms. Humans in fear do repetitive patterns, which I've observed again and again and again. Therefore, fear that drove the 19 corrective phase is no different to this one, and I believe it can be measured, quantified, and assessed with a reasonable degree of accuracy to present you with potential opportunities. Starting with the 2019 corrective phase, I want to make a first point, which was the first point within my list of points that I want to make today, which I should have beside me and I haven't got organised. Here it is. That is the context of a correction. I'd like you to make an observation that the corrective phase, which I'll draw from 19 to the bottom, how many months? If you can count the squares on screen, it took 3 months. I'll do it for you. If you were to count the squares on screen with the current corrective phase, we are only 1 month into a financial cycle, okay, not economic, financial cycle that is in a corrective phase that could take between 1 to 3 months. If the speed of negative news is extremely rapid, that can be reduced back to 2 months. But I want to just first of all make sure you understand there is no way that what we're experienced is it. That's just the opening salvo, because it's too soon. Corrections do not unfold within 4 weeks and then they recover, especially when I show you what I'm about to show you. Okay, next I want to just discuss something called, it's a three-wave structure, it's a technical structure. I crudely call it a dog leg. It's just, look at my screen on the far left of screen. I'm just drawing in a fall, a small rally and a fall. That rally, that fall, small rally and fall takes approximately 19 days or thereabouts. And the two ranges to the downside approximately equal each other. I would like to point out that that particular type of unfolding has only just occurred within the current market. We have got a fall from the high to the first rally, small rally, and then a capitulation, sorry, not a capitulation, and then a fall. The ranges weren't equal. They don't have to be equal because there's different news driving them. But what I call the dog leg, that's the initial beginning point or the first three-wave structure of a correction. That's where we are in this correction. So the key is to map out where are we going to go next. So I've already given you the two alternatives. Straight capitulation, which would mean massive negative news like starting now, or something that has the market rally, which would be positive news. Can anyone think, I already know you know the answer, can anyone think of the positive news that has just occurred this morning which may drive this market up? It's the agreement, I hear you scream at me, between the Republicans and the Democrats for a $1 trillion or times trillion package to support the US economy through this crisis. And that could ignite a small recovery, okay? So let's just work on the potential that, yes, we could get a capitulation, or we could get an orderly correction, which means the market may do a rally, may fall, may rally again. If you get a pattern like I just drew on the far left of screen, the first or the second opportunity that I know is going to exist in this market is what I call the capitulation point. Am I sure that it's going to be orderly like this? No, it won't. It may not be. It may be a short rally, then a capitulation. Again, it's too soon for that to occur. But if you see an orderly, what I call a left shoulder of an inverted head and shoulders pattern occur, you have got the most amazing opportunity to short this market through whatever instrument you're comfortable with and make yourself a big bag of money. I am very good at picking rollover points on small rallies, and I definitely will be doing that if I choose to in the weeks ahead, if it presents itself to me. So the second point I'd like to make out is, how far can the market fall? If it does capitulate, well, again, I'm going to use this as my template. If the market does a fall, we could use Fibonacci ratios. I'm going to use the first range from the high to the low and mark it down for the capitulation point. I want you to note that the capitulation is 1.618 Fibonacci ratio from the capitulation point to the low, which almost coincides with one of these blue lines that I've drawn on screen, not very accurately. I'll show you what the blue lines mean shortly. So that is my template for an orderly unraveling of the current market. So let's just come across, and now we're going to do some Fibonacci projections to give you a sense of where the market could get to. And again, this is a guess based on, on a pattern which may or may not occur. So markets, when they rally, they won't go right up the top. They'll get just above the moving average where it'll find resistance. They may fall back, they may rally, and if that's what occurs, I could do an estimate just based on the first range to the downside, mark the market down from the capitulation point, which I've just put on screen, and I can start putting levels on screen which are important. So I'm going to mark up the chart with a weekly chart, and I've got a level down on screen, down at 1920, which seems a awful way down the screen, but it's possible, okay? And I could have done that a little bit higher, and it would have coincided with the second blue line. So I'm just going to leave these thin blue lines have a meaning, which I'll show you. But that's how I get a sense of where the market's going to get to based on previous market moves. Now, these blue lines and trend lines that I'm putting on screen, I want to stress they are meaningless, and people probably are choking on their Wheaties right now for that comment. But in this market, they are meaningless because they're just lines on a screen. And when people look to Technical Analysis 101 and try and tell me that that's where the market's going to stop, I don't think so. So let me just discuss the rest of these blue lines, and let me discuss what's a meaningful support line. If I contract up this screen, first of all, there's a 45-degree thick blue line on screen, which represents the range from 2009 to, that's the 45-degree thick blue line. It's 2009, touch the 2012 low, touch the 16 low. That is a significant support line. Touch the 2019 low, and I've drawn it very poorly. I'm going to redraw it. Okay, so I'm just going to draw it again from 09 through the market. Okay, now I've drawn it correctly. Now, as that market was approaching that historically significant line, and it sliced straight through it, it was absolutely obvious to myself that it was a significant line this time around due to the behavior of institutions around that line. So support lines are only significant if you've got another level of information on these lines. The lines in themselves are just lines on the screen. And as the market falls and hits these levels, I will be doing, and I do a lot of work for my private clients in justifying and analyzing the significance of these lines. I can tell you there is no line on screen in the foreseeable future that has any technical significance as a potential support line. And let's go a little bit further on this topic, because I could also look at this market, apart from doing projections to the downside, I could divide ranges up. This is probably my ultimate template, I think, to be used in this crisis. And that is divide the range up from 2009 to the high, recent high, and you might notice that the division of range, that is the Fibonacci divisions, 0.382, 0.5 and 0.618 coincide with those thin blue lines I drew up on screen. So now you know what the thin blue lines are, and they are my levels where I will be absolutely focused in technically analyzing lows. And I know what constitutes a low because I've done this many times before. In 2019 low, I was in 3 or 4 or 5 days after low kicked in, but I can justify it. It's not a guess. So let me just delete that too much information on screen, and I would like to ask you a question. If I could just clean up this screen just a little bit, this is too much. Just in your head, just looking at a raw picture without any in-depth analysis, what is the likelihood that the market can get to the next blue line, which is the 50% line? You'd have to say if market falls over again, that's easy. And if it goes 50%, it can easily get to 0.618. So if it can get to 0.618, which is a normal pullback in a normal market, it can do it in this crisis. The key point is that these lines have significance at a future point in time if you know the exact, what's defining a line around these support lines. I just want to put up something that if you want to, and I've told people, put me in a straitjacket, please be my guest, but I'm just going to put up a line from the 80s, which represents a 50 to 58% pullback in this market. And that is the most silly thing that I could put up on screen, because how can a market pull back 50% or 58%? Well, actually, if you had asked me the same question back in 1987, it did it. If you had asked me the same question if I was in this industry back in 2001, it did it. If you asked me the same question in 2007, 2008, it did it. So why can't it do it today? The markets can do whatever they do. And as we get the destruction of not destruction, but the fear-based selling of really high-quality stocks, I assure you anything is absolutely possible. That is unlikely, but still possible. My most likely scenario would be 0.618. I can't tell you which one it is because I can't see into the future. I do not have a crystal ball. What I do have, though, is a set of skill sets to analyze markets at specific levels and come to a justified determination, which forces me to act. Of course, I'm going to put in stop losses, and if I'm wrong, I might have to have a second try. But from my history, you know, I have a high degree of ability to justify lows. They're just way off. When I use the term way off, why? Why is this market way off in time from hitting one of these lines? The answer is found in the VIX. Okay. So we can see, and I'm making assumptions here that you all know what the VIX is. If you don't know, go Google it. It's known as the fear index in short, and it represents the demand for put options within the S&P 500. And this is not a price index, it's a fear index. So as the demand pushes the price of the options, they grow in value, and that value implies a high level of volatility, and this is basically a chart of the aggregate demand for put options. So I just want you to notice there's two blue spikes on the screen, and those two spikes, where they reside, they represent something that I showed you earlier. It's the dog leg on, on the price chart. And the dog leg is just stage one of the evolution of a corrective phase. I am quite sure the volatility once starts, it goes for days, weeks and months, not 1 month, not 4 weeks. And the reason I know this, because I've lived this numerous times. I could go back to 2019. I'm not going to do it numerous times, but I'm going to do it in 2019 and put 2 arrows on screen. That represents that dog leg that I showed you on screen, the first fall within the corrective phase within the 2019 fall. And what you'll observe going to the right from those two lines are many touches of the VIX having a rally, ending up in the capitulation phase, which was 3 months later. That evolution of the VIX and its many rallies over a period of time is just how it is. That's how the market unfolds, and I could go back, as I said, and show you many, but I just want to give you a sense. Why am I pretty well sure that this is the beginning with not even at the midpoint? The midpoint I've said is the capitulation in technical terms. It's because of the VIX. That tells me that there's much, much, much more to come. Okay, just give me one moment. I'm just going to go back now to the price chart. So just give me one moment. I'll just come back to the VIX at the current point. Okay, so just keep in your head, there's 2 blue lines on screen which represent the dog leg. Now let me just put up the picture again. So here we go. There are 2 arrows that I'm going to put up on this screen which represent the first 2 spikes in the VIX. So that's it's just a mirror image of each other. So I ask you, common sense tells me there's lots more to come, and what will be absolutely beautiful will be a rally at this point, which will be giving us a beautiful setup for the second opportunity. The first opportunity, remember, I did a currency hedge, then I'm shifting and waiting patiently for the second opportunity, and then the third opportunity will be the market low. The doomsdayers tell me that there's a recession on the way and don't invest in stocks. I've tried to get you your brain's right that there's 2 cycles. So you now know that's not true. I also know if the market gets down to any of those levels, it is so oversold, it will bounce. I would also suggest for the first time in history, the planet has not stopped working. We are all working from home-based offices across the planet. Many mid-level to high-level professionals are hard at work, so the world has not stopped. And of course, there are certain job areas that have stopped, but to a large extent, the planet is still working in real time. We are communicating across the planet, and we are analysing in every industry and producing. The workforce is young and undamaged at the end of this, if we believe the stats. You know, the younger you are, the better chances you have to have a mild illness if you even get an illness, and we all know you don't have to get it, just stay in your office. So all the liquidity that's being pumped into the market builds, for me, a very positive picture when we actually find a low within this market. Just give me one moment. I just had many topics to talk about then. I talked about the context. I'm just going through my list. I talked about time. I talked about the dog leg. I talked about technical price structure. I gave you an insight into the VIX and how it assists me to sense the timing or how much time has got to go. I talked about meaningful support lines, Fibonacci projections, and I talked about there's 2 cycles in the market. So I think you've got a really good sense of how this should unfold. So let me just get rid of my price chart, bring across my PowerPoint presentation, and I stress I could talk for 5 hours, but I promised people that I would do this in an update format every week. So if you listen to it next week, it's kind of the same thing. But last week I didn't do cycles, which is a valuable insight into how professional people are thinking, and will help you insulate yourself from the negativity you're about to see unfold within the market, and also the fear-based news, and avoid ending up like this guy here. We want you to be, as I said, I want you to end up like this gentleman, and there's absolutely no reason you need to be financially damaged in any way. In fact, say you've even lost a few dollars in this so far, the worst thing you could do is get into your tortoise shell and do nothing. If you're active within this market, you can have the ability to rectify. I've just given you one opportunity. I just gave it to you about 2 minutes ago. That one opportunity could resolve itself in a 28% capitulation. Anything that you've given to the market, it will give you back if you do it right. I know this to be true. This is my screenshot from one of my accounts back in 2019. So this is simply from December 26, I'm just showing you what's possible, to the 31st of July 19. That's me. The low occurred on the 28th of December, I believe. I was in the market from the 6th, 7th of January. This is what's possible if you are active. If we have a V-shaped movement in the financial cycle, a 22% over roughly a 6-month period is absolutely possible. And what you'll see is a major rejection of that low with big moves on a daily basis for the first 2 weeks as the market senses the end of this crisis. And the end is not the end of the news that we're seeing. The end is sensing the end. The market is designed to sense it. Forward looks. It's a forward discounting mechanism. It doesn't see the future, but it senses recovery and then factors that into the present. And that is really confusing because markets start rallying in the context of a negative flow of news, and that's very confusing to a non-professional. To me, I love it because I can disconnect between the two, and I've tried to do that for you today. I can absolutely operate in what is a counterintuitive exercise in the context of negative news and buy stocks. Because why? I've got the tools, the knowledge, the experience, and the stability to do so. So I'd just like to ask everyone in the room, Using my guidance, if I can replicate similar performance generated for the 2019 low, what would this be worth to you? Do you think I am of any worth in getting you through this period? I've promised for my active clients to define the end of this corrective phase in real time, and they all know how I'm doing it anyway, because that's what I show them, and present a new unique opportunity to produce superior returns by the end of 2020. I didn't say end of financial year, I said end of 2020. So how can I help you? If you want some help, I have set some time available. I've set some time aside next week if you want to speak to me personally. I will assist you to make a series of decisions that are based on objective measurement, not fear-based, subjective, exciting hearsay that you're reading off the internet, that has the potential to deliver the best returns that you have ever achieved. But I don't want to speak to everybody, and I just need to qualify you. I only want to talk to people who are 100% committed to success and to hitting investment income goals. It means you've got to act, no matter what, by following the guidance I offer. I like to talk to strong, goal-orientated individuals with confidence and good organisation, which means you've got to be not high anxious at the moment. You're going to be low anxious, planning, strategizing. I want you to value knowledge and understand its transformative value, and I'm good if you don't call me, but if that fits your profile, you can call me, because on the call I will examine your investment goals and I'll help you to get absolute clarity on how to reach them fast. And I've been doing that. I'm really busy at the moment trying to assist people to see the positive and get prepared for the opportunity. If I work with you, I'll walk you through a strategy that is designed to position your portfolio to take maximum advantage of what I believe is a once-in-a-lifetime opportunity, investing in equities, bonds, precious metals markets. By the way, it should be equities, should be the category, the asset class, but if we go into a cycle of severe destruction, it could be precious metals. I can't tell you that till we get there, but I'm still in my head thinking it's going to be an equities, a really big equities move after this, after the fear cycle is finished. If you want to talk to me, I can offer you my time, but you need to book and schedule. There's a link within the chat panel and there's a link within the question panel. I really would like you to use that link because it sends a go-to-meeting link and I can organise my time, we get reminders and we're able to talk to each other in an organised fashion. So that link on screen is not live, copy it or use the link in the chat panel or the question panel. So now we've got two choices for you. You can do nothing, crawl into your tortoise shell, and you know it requires zero risk, zero faith, and miss out on a unique opportunity, which I know is about to occur, which is occurring now in real time. Or invest some time into seeing what's possible. Talk to me and see what is possible for your investment future. Be willing to strategize out of what or where you are, and maybe you're fine and cashed up, well, all the better. Be willing to implement a strategy and create a future life that you're looking for. I'd just like to thank everyone for their time. I really appreciate your time, and I've tried to give you something which is of value this evening. It's now this evening on my side, and I look forward to talking to everyone sometime in the near future. Thank you and good night.